Right, so let's get to it. So our first speaker is Bruno Taillardat, who is Global Head of Smart Beta and Factor Investing at Amundi, and he'll be speaking on the title Trials and Tribulations, A Year in the Life of Factor Investing. Over to you, Bruno.
Thank you so much. Hello to everyone. So I'm very happy to be with you today, well, at least virtually, and to talk about factor investing and more specifically what happened to factors. Because for sure, the period that we have seen recently has been a challenge in terms of performance. But of course, we believe that there are good reasons behind it, and I will, of course, cover the different parts of the factor performance and the main takeaway that we can get from what we have been living through. So yes, my name is Bruno Taillardat. I'm in charge of smart beta and factor investing. And today I will cover first the performance of factors, then some issues that we have seen behind them, and of course some, I would say, going forward elements that may be of your interest. So we can start with I would say first cover what we mean by factors and what are they and what do we mean by factors. So what you see on the slide that you see here is a mapping of the selected factors that we have at Amundi, which are, I would say, the most common ones, which are momentum, size. Size, we mean by that mid-cap stocks, value, quality, and low vol. And there are two axes on the chart. The vertical axis shows the underlying data that we take into account to construct the factors. And the horizontal axis shows the source of performance we expect to see from each factor. So, for example, momentum is clearly more price related, while quality is mainly fundamental driven. So that's for the data which are behind the factors. And probably more interestingly, what we see from the horizontal axis is that they are linked to different sources of performance. So size and value, for example, would be what we could call risk premium factors. By that, we mean that when you invest in a value factor, for example, you take a higher risk. It is a higher beta factor. So because of the risks that you take, you need to get extra returns. That's the concept of the risk premium. While on the right, some factors which can be perceived as more defensive, like quality and low volatility, sometimes linked to some form of market anomaly, and which tend to be rewarded when the market is more turbulent. What is important behind this slide is more the concept of diversification. Because as you can see, if we build a portfolio well balanced across factors which have different data behind them, which have different sources of performance, this is a very good ground for performance. So to talk about recent performance of factors. So what happened, and clearly we have seen a rough year for sure. It is even a bit of understatement to say that it's a rough year. And factors, to be fair, have been turbulent and have suffered. So I'll try to illustrate why and how and what we can think about what will happen going forward. Looking at performance over 2020, this is the 5 factors that we have built at Amundi, so based on proprietary factors that we have. Well, first of all, what you see is a value factor, which is represented by the dark blue line, which is underperforming day after day since the beginning of the year. And you can even see that during the I would say the crisis, the big market downturn in March, it was very, very turbulent, as well as the size factor, which is represented by the yellow color. And behind these factors, there are clearly some credit risk, illiquidity risk as well, which is one of the reasons why these factors suffered, because at that time, of course, we all remember that there was it was a risk which was very, I would say, problematic for long-term investors. By contrast, during the downturn, low vol did well with the light blue line, as well as quality, and of course, they are defensive factors. So they tend to be, I would say, outperforming when the market is I would say, turbulent. However, looking at low volatility, as you see, after the crisis, it tended to decrease also month after month, especially during summertime. It had also some turbulent times, underperforming some other factors. And the big winner is momentum. As you see, momentum, so the let's say red color, profited big time from the rally. The rally that we saw, which was accelerated during summertime, and momentum was the best factor to be exposed to. To some extent, quality was also okay, but clearly momentum was much better. So that's for the global picture. And in fact, on average, if we just take an average of the 5 factors, you see the dotted line, which is represented on the chart, on average, it underperformed. So the multi-factor strategy, which would be diversified across these different factors, had underperformed in 2020. So what is interesting is to put that in some perspective. So, for example, the size and the value underperformance that we saw in March, and as you see, the circle here represent March, has been very, very extreme. Because if you, for example, focus on value on the chart, which is on the right, you see that the underperformance was very, very pronounced. If we compare it to the last 17 years, it has been unseen in this historical framework. So it's, of course, quite an extreme event, and which was not well compensated by the defensive factors. Because if we go to the next slide, we have the same chart for low vol on the left and quality on the right, so which are more defensive factors. Yes, they outperformed, as you see at the right part of the charts. However, the outperformance is not enough to offset the underperformance that we saw in value and size. So that's why multi-factors at that time suffered. Also, it was, if we look at low volatility on the left, the outperformance was delivered, but it was much less pronounced compared to another crisis that we saw in 2008, which was the GFC, where, as you see, low volatility was quite interesting to deliver some sort of protection, or at least some defensiveness, which was not really achieved during this crisis. And in fact, some of the explanation is also linked to correlation. Because what we have seen in 2020, especially in Q1, was a sharp increase of correlation in the stock market in general and also in factors. And to represent that, we have done some analysis, which you can see on this slide, where we compare what we call implied correlation between stocks. So what we mean by implied is a kind of ex-ante measurements or an indicator coming from models, compared to realized, which is the light blue bar. So in normal conditions, you have a fair comparison between the two. For example, Q4 2019, it was not that far away. Q2 and Q3 in 2020 was at the same level. What we have seen in Q1 2020 is a big increase, a very sharp increase of the realized correlation. And so probably the ex-ante measurement was underestimating the real level of correlation between stocks and factors, which, you know, can happen sometimes. If you think back the GFC or another type of crisis before, it is a typical sell-off mechanism where the whole market is sold, and then at the end of the day, you don't have enough, I would say, dispersion or diversification opportunities to amortize the effect. And in that time, well, diversification is not really helpful because the correlation just jumps to a very high level, almost 1. We observed a similar phenomenon on volatility, and this is why we did the next slide, which is the same type of analysis on volatility, where we compare volatility in ex-ante, which is the black or strong blue, dark blue bar, compared to the light blue bar, which is the realized volatility. And again, you can see here that in Q1, the volatility was underestimated and the realized volatility was much higher than expected. And of course, we remember that it was a very sudden event, that the market corrected sharply suddenly, which is one of the reasons why the volatility was probably underestimated. As a consequence, much higher volatility, much higher correlation also means much higher beta in general. And so if we look at the different beta of the different sectors, again, ex ante and realized. So this is what we do. We look at different sectors here, sorted from low beta sectors like utilities and consumer staples on the left, to high beta sectors such as tech, semiconductors, and so on. And so this is based on ex ante beta, by the way. The sorting is based on ex ante beta. And what you see again is that there was a sharp increase, especially on the low beta sectors, which are supposed to be low beta, like utilities, real estate, staples, and so on, which were, in fact, in reality, much higher than expected. And so again, it's a sell-off. There is little discrimination between the different stocks. And so in terms of sectors, that's quite, I would say, limited in terms of dispersion. And it's also true for factors. They exhibited quite high correlation, which means that diversification was not really helpful in this period. If we compare this type of analysis sector-wise in more normal conditions, at least what we have seen in Q4 2019, you see that you have a fair comparison, a good relationship between ex ante and realized. So that was very sudden and specific to the Q1 of 2020. Again, as you see, especially on the defensive factors, the low beta stocks on the left, which were not that low beta at that time, when we look at realized data. So I would say that's for main reasons behind factor underperformance in the multi-factor underperformance in Q1. And there was also some other effect which was in the market, especially what we can call concentration risk. And in fact, concentration risk is quite an issue, especially in the portfolio construction, because it's sometimes more difficult, more complex to address, to assess. You have a high idiosyncratic risk behind concentration. In terms of factors, it's less also efficient because factors want to, I mean, the purpose of it is to diversify and to be exposed to common risk as opposed to idiosyncratic risk. And this is something that was also not very favorable for the different factor investing strategy because the market has been very concentrated, especially in the US. So the first, I mean, concentration risk can take many forms, but the first typical concentration risk that we can see is in terms of stocks, and especially when we look at the mega cap stocks in the US. So what you see on the chart here is the composition of the S&P 500 on the left. So we look here at the 5 big stocks, the biggest stocks, which are Apple, Microsoft, Google, Amazon, and Facebook. And they tend to represent 16% of the allocation of the Standard & Poor's 500 in terms of stock composition, which is already quite high because 16% just driven by 5 stocks out of 500 is quite significant. But which is much more important and quite impressive is the return contribution of these 5 stocks to the total return of the Standard & Poor's 500 since the beginning of the year. And that's what you find on the right. What you find on the right is the return contribution of all the stocks. It means that they represent around 16% of the index composition, but at the end, they contribute to almost 95% of the return of the index. So that's clearly a very high concentration risk that we have seen, especially in the US market, especially in summertime. And this is where factors which are supposed to diversify and potentially more mid-cap oriented sometimes underperform because of that effect. So that's a form, of course, of concentration risk. This chart, in fact, I would say there is behind it a compounding effect, which is quite important. If we, in fact, look at the following slide, which is the time series since the beginning of the year of the Standard & Poor's 500 with the dark blue line compared to the same index without the biggest 5 stocks, you see that, in fact, the biggest 5 stocks not only they had a better participation to the rally, much better, in fact, they drove the market during the rally, but also they could provide some sort of, not protection, but at least drawdown minimization when the market was very turbulent in March. As you see, they created already a kind of gap during the downside, and then they had a much upside capture. And at the end, this is why also they explain the majority of the return of the index. It's because they had some amortization during the downside and a very good upside market when the market was more bullish. So that's for what we could call a concentration risk driven by the biggest stocks which we observe in the Standard & Poor's 500. There are other forms of concentration risk, and sometimes some factors can exhibit concentration risk. And there is one which is quite interesting, which is momentum. And in fact, when we look at momentum, we see that the index, the Standard & Poor's 500, is very exposed to momentum and has a kind of overexposure, or at least a bias, very strong bias towards momentum factors. And so what you see with the line and the dot is the exposure of the Standard & Poor's 500 to the momentum factor. So it's in Z score, so the more positive, the highest is the exposure. And this is since 2016. So of course, momentum factors tend to vary depending on market conditions. But what we see starting in 2020, in Jan 2020, is a sharp increase of exposure of the Standard & Poor's 500 to the momentum factor. Very sharp, very sudden. When we analyze what were the main drivers behind the momentum factor, and we look at the main contributors, the main stocks that are the most exposed to the momentum factor, not surprisingly, we find again the 5 usual suspects, which are Microsoft, Apple, Google, Amazon, and Facebook. As you see, especially in summertime, the biggest stocks were the most exposed to the momentum factor. So that's how we see today concentration risk being very high, both in terms of sometimes big stocks in the US, but also some exposure to the momentum factor, which is very, very high. So what are we doing now with factor investing? Can we consider that factors are dead, or we can forget about strategy invested in factor investing? Well, obviously, you will guess that it's not the case on my side. Of course, I don't consider that factors are dead, and quite the contrary. I think for portfolio construction, it makes a lot of sense, especially for long-term investors. Of course, there are some short-term events that can affect the performance. However, factors are there for a good reason. And this is why they are valid and they are documented for a very long time in the industry. And especially in this period of time, I would say that factors are more necessary than ever. I think it has never been so much the case to be exposed to factors. I think it's more crucial than to have them now than ever. Why? Well, because as you know, we navigate in very volatile times. And if you think about the sources of volatility going forward, there are multiple dimensions. So I just try to summarize here some example of where the volatility can be very high and can come from. For sure, the uncertainty around the US election is one of them. We also know that the economic slowdown across the globe can affect the equity market and can drive volatility higher. There is also a lot of uncertainty regarding the trade war between the US and China. And of course, last but not least, the outcome of the crisis of the COVID is still uncertain and also depends on some elements such as the vaccine and so on. So volatility, I think, is there and will increase. And in fact, we believe that we enter in a period where there are more uncertainties and higher volatility. And in this period of time where the risk is coming from different sources, where the risk of tomorrow will be potentially different from the risk of yesterday, I think there is one good answer, which is to diversify. Diversification is clearly useful when you have little certainty, little visibility on what can happen going forward. And in fact, According to us, diversification is well achieved with factors. So what we show here on the slide, and here we take the MSCI factors, the style indices. We started in 2002, and we look at the performance of all the factors year after year. And we want to show here that the factors have different cycles and can bring high diversification to a portfolio, which would be well balanced across the different factors. For example, if you follow the dark blue box, which is value, recently it has been very challenging, as you know. But if you look back at 2003, 04, 05, 06, and so on, you see that it was a well-rewarded factor. And it's quite interesting to see that you can also detect some good complementarity. Usually value goes in different direction compared to quality. They tend to be a bit opposite. And so that's in terms also of diversification is a good hedge to have the two factors which exhibit different characteristics. And also we believe that over the long term, all of these factors are rewarded, but they have different cycles. So some of them will better profit from a certain market environment. Some others will profit from other environments. And having all of them together is a good ground to build a well-balanced portfolio and to navigate the equity market over time, especially if we believe that it's quite uncertain and that the volatility can be higher. For some investors who are really cautious about volatility, there are also other techniques, other ways to mitigate the volatility while being fully invested in equities. And for example, defensive strategy like minimum variance could be a good solution so that they can help to mitigate the risks and to deliver good performance because of the risk mitigation and the risk reduction. However, minimum variance in this case has to address a wider spectrum of risk, and we should probably look beyond just low volatility and to think about where the risk is coming from tomorrow. And so just as an illustration, what we show here is typical risk factors that we should potentially add to the low volatility framework so that it could complement the portfolio construction and address other form of risk which can be multiple and which can vary over time. So there are some bottom-up risks, for sure, linked to some companies. For example, it's important to make sure that we invest in stocks which have good fundamentals, which have low credit risk, which are stable over time. You need to make sure that the portfolio is liquid enough, does not exhibit any crowding effect. ESG is, of course, quite a key component, and I'll come back to it. And there are also some top-down risk elements that you can integrate in the minimum variance portfolio construction, which can be coming from macro risks, sovereign risk, or valuation, even to make sure that you are not overpaying for defensive portfolio. So that's for a strategy which is called minimum variance, which has the merit to minimize drawdowns and minimize volatility. To come back to factor investing per se, we believe that there may be some new factors emerging going forward. Potentially one of them, which tends to take more and more importance, is ESG. And in fact, we have carried out some research at Amundi on ESG to analyze to what extent it becomes a new factor. So, of course, we have to be prudent and to have a time frame which is not too long, because, of course, we cannot backtest something which was not existing 20 years ago. But over the period of 2014 and 2019, we analyzed some performance pattern, and we start to see some evidence that ESG become a new factor. So what we see in North America, here on the left, is a technique that we applied to decompose the beta of a market into different factors. In fact, when we want to impose low factor intensity of the beta explanation, if you will, it's like if we break down the beta in different components. If we want to have low beta explanation from factors, there are two factors which emerge quickly, which are quality and ESG. So ESG is a factor which starts to be quite valid in the US. However, when we increase the factor intensity, there are new factors emerging, such as momentum, low vol, and so on. And at the end, as you see, ESG, if we want to have a full exposure to factors in a multi-factor context, in North America, ESG is less interesting because probably it has some overlap with some other factors, such as low vol, for example. Well, in Europe, it's not the case. On the chart that you see on the right, ESG, first of all, is the first factor that emerged over the last 5 years when we look at the historical data. And for sure, there are a lot of, I would say, investors investing in this new factor, a lot of managers, I would say, launching new products on ESG. So for sure, it creates a positive feedback loop. But you see that ESG is a factor which tends to dominate. Then we see that the other factors also emerge when we increase the factor intensity or the breakdown of beta, which is explained by factors. But even at 100%, you see that ESG is still a quite important factor. So in a multi-factor context, in Europe, ESG can clearly be considered, according to us, as a factor alongside momentum, quality, value, level, and size, for example. So that's what we can say from this ESG factor. And probably I would like to end this session with a conclusion, which I would say would be articulated across the investment convictions that we have. Because I think behind factor investing, we have to show and we have to demonstrate that we have strong convictions and strong investment philosophy. And that's important. We believe in factor investing because it's an efficient way to construct a portfolio based on rewarded factors. But I think the investment convictions have to be clearly explained and documented. So what we show on the slide is a kind of summary of the main investment beliefs that we have. And so as you see, we believe that the best way to deliver consistent performance over the long term is by managing risks. That's first. Then, of course, we also know that risk is multidimensional. Risk is coming from different sources. So the best answer is to diversify. And we believe that a very good way to diversify or to build a well-diversified portfolio is to use rewarded factors such as value, momentum, level, quality, size, and so on. Last but not least, of course, a good way to address it and to manage a portfolio like this is to rely on a well-disciplined and structured investment process, which would rely on some quantitative models, but last but not least, which would rely on a long experience and a strong experience in managing factor-based portfolio. Thank you very much for your attention, and I'm more than happy to take any question you may have on factor investing.
Great stuff, Bruno. Yeah, we have had a couple of questions come through from the audience. Just on correlation, one question was, did we experience a similar increase in correlation for EU markets as well as the US?
Sorry, can you please repeat the question, please?
Did we experience a similar increase in correlation for EU markets as well as the US?
Yes. However, it was to a lesser extent, let's say. The US was really the most pronounced movements that we detected, but clearly in Europe, it was also the case. But, you know, also the main difference is that in Europe, you have, on top of factors and stocks, you have a very strong dimension, which is countries and currencies. So this is why the correlation was, I would say, less extreme compared to the US, because you have more opportunities to diversify across different countries, currencies, and so on, so which reduce a bit the correlation level we may see.
Good stuff. And another question we had was, it's a very interesting one. Considering the new risks we're exhibiting in 2020, do we still expect the 5 main risk premia that you highlighted to have the highest explanatory power for asset pricing, or would you expect to see more types of risks becoming significant? I know you mentioned ESG in there, but are the 5 main one's the key to look for still?
Indeed, it's a very good question. Yes, I think, well, first of all, you know, the 5 factors that we talked about have a very strong and long-term history, and they are well documented and they have lived in different cycles. So I'm a bit cautious and prudent when I try to assess new risk. I think we should also think about long-term and imagine how it's going to affect asset prices. However, we can see the emergence of new factors, and I think ESG is one of them. And it may be also a very strong outcome from the COVID crisis, because there is clearly, I would say, more attention on the social aspect of the company's governance for sure. And there is a much stronger signal today, which is environmental, especially with the carbon risk. which is more and more assessed and identified by investors. So that, to me, ESG may be clearly stronger after the COVID crisis, for sure.
Yeah, good stuff. And I know you mentioned value. Do you think you could talk a little, it's a bit of a hot topic, do you think you could talk a little bit about why value has been consistently underperforming, and also why it underperformed during the rebound as well?
Yeah, well, that's also a good question. Thank you for it. It's in fact value is clearly a challenging factor. It has a high beta. First of all, it is a high risk factor. So in fact, there is no surprise that during a crisis, this factor underperform. And for me, value is more also a factor which is a good proxy for good surprises, for positive surprises. And in fact, there are also some macro explanation, because value tends to do better when interest rates are higher, when the economy is improving, when there is more an expansion than a recession. And so for sure, in the current environment where we have low interest rates, a recession everywhere, and some uncertainty again, value is not a factor which tend to profit from it. During the rally, because yes, you expect value to outperform in strong bull markets, but the rally was mainly driven again by very, very big stocks, which were perceived as more resilient compared to the value typical stocks like energy, for example, which is a big component of the value factor. And that was negative for value, because the rally was driven by another theme in the market, which was more big cap and in fact IT stocks in the US. But I would say that to summarize, I still believe in value for diversification purposes. Because of course, what you don't like from value is, I would say, what we call deep value or value trap, where you invest in stocks which are there for good reason. They are cheap for good reasons because they have some credit risk. But when you combine it with quality, with low volatility, with momentum, you tend to have a good mix, a good balance, and value on the long term should have some strong benefits in terms of diversification.
And I know you touched on them briefly, but the market conditions that would cause a return to value, is it effectively less quantitative easing and a return to higher interest rates?
Yeah, well, I think it's there is a link for sure. I mean, the fact that we have interest rates at very low level, it's more profitable for factors such as low volatility, for example. So that's something which is quite well documented, by the way. But value is also there to also catch up. And again, it's a proxy for positive surprises. When you have, I would say, positive events or positive news coming from the market, this is a factor which can help to catch up and to capture some part of the equity returns. But again, for me, it's clearly a factor which is useful in a multi-factor framework, making sure that you are not exposed solely to value, which can be quite complicated currently, but you use value in a diversified portfolio that would make sense, I think, for quite a long time.
And do you think one thing, bit of research I've seen is, do you think value metrics almost need to be reassessed? Is price to book still cutting it, sort of?
Yeah, yes, I think it's also a good consideration for sure. I think there may be some refinement to apply to the value factor. Most of the indicators that are used are based on simple metrics such as price to earnings, price to book, price to cash flow. But for sure, there are new elements which are potentially underestimated by this, especially by the price to book. We talk a lot about intangible, for example. That's, I think, a nice improvement to make sure that we can also integrate some, I would say, less tangible elements in the balance sheet measurements. So clearly, there are ways to improve, to refine the value factor. For sure, and that's also what is interesting behind factor investing, and smart beta in general. I think, in fact, we need to be engaged in research. We need to innovate a lot because that's how we can make sure that we evolve over time and that the investment process is still valid. Of course, you need to have strong investment philosophy. So you can do a lot of innovation, a lot of research, but it's important to, at the beginning, state what you want to do, what is your objective, what do you want to achieve, and this is why I mentioned we need to show strong convictions, because it's not a magic formula. There are some cycles, so you need to make sure that you have investment convictions and investment process, which is well structured around your convictions.
Great stuff, and we've got time for about one more question. One from me is: were there any surprises for you from a factor perspective during the volatility?
Well, I think what was not really expected, what in Q1, when we had this big market downturn, to have such, I would say, underperformance of the size, of the value, and maybe more importantly, a kind of lack of benefit from diversification. And this is something which, in general, is less pronounced. Of course, we have been managing. A lot of us have been managing factor-based solutions for a long time. So we have been living in different cycles, and we know that there are some different cycles anyway. And so, in this type of market event, it's not a big surprise to see a sharp increase of correlation, but this time was very, very extreme and very pronounced. So that's, I think, what was a bit of a not surprise, but at least not really expected from the asset managers and the asset owners.
Fantastic stuff, Bruno. Yeah, massive thank you for coming on. That was absolutely fascinating.
You're welcome. Thank you, and I hope you will have a nice afternoon.
Thank you very much.